Welcome to the Wade Borth Podcast, where fresh thinking meets financial freedom. Each week, we explore ideas that challenge old habits and light the way to a stronger financial future. Let's get started. Hello, welcome back to the Wade Borth Podcast. Today, I have an amazing individual, somebody that I've just been recently introduced to, well, semi-recently, through a common acquaintance of ours, a great gentleman by the name of Paul McHale. Thank you, Paul. Shout out to him for introducing us. Salted Earth, beautiful individual. I love Paul. So I'm glad he brought us together, Ro. And I'll introduce Rohit Punyani. So again, we had a lot of conversations, but I always like to stumble over the last name. So thank you for giving me a little bit of grace to, nobody has a simple name like Borth, right? B-O-R-T. It's simple, right? And so Punyani is probably a little bit challenging for us German-Irish people. So thank you so much for the opportunity.
Yeah, no, I appreciate it. Just call me Ro. Wait, don't worry about it, man. We've hung out. We traveled together to Indianapolis. So we're old souls now, man.
Yeah, exactly. So yeah, everybody calls him Ro. His friends call him Ro, and he's allowed me the grace to call him Ro as being one of his friends. So I really appreciate that. So Ro, today we're going to talk about, and again, this is exciting for me because this takes me back to something that, similar to what I used to do years ago. I found a lot of enjoyment, a lot of excitement around this, but it just wasn't there. So we kind of went a little bit different direction, but I find your story and my story really interesting. They kind of weave together. So we're going to talk about the idea, again, we're going to talk about a lot of different things, but ultimately it's going to be this idea of how do we as business owners, as people that have decent income, how do we plan and do a better job of being leaders in our financial life and our business life by maybe reducing the amount of taxation that we have and by bringing certainty to our retirement future. And that's ultimately what we're going to be talking about. And I know your specialty lies in cash balance plans. That's what we're going to talk about today. But you also have an affinity and a love for infinite banking. So that's why I love and I'm excited about this conversation. So maybe just hit us off with a commercial. Why should people continue to listen to our conversation for the next, 3 hours? No, I'm just kidding. Anybody that knows me knows I don't talk for 3 hours. Why should people continue to listen to this conversation? What's going to be the benefit to them?
The benefit for them is a 6-figure tax deduction for a 7-figure retirement that is guaranteed. 1 sentence, there it is. Okay. And so if you own a business, Wade, the IRS incentivizes you to use the tax code to your advantage. Yep. That's really the nature of the dialogue. Every business owner's struggle is generating free cash flow, first and foremost, revenue, and then stopping the leakages, and tax is the biggest leakage. So that's the conversation today is there are ways for folks to have 6-figure deductions for 7 figures worth of assets, period.
Love it. Anybody that knows me, listen to my podcast, knows I'm a plain language individual. We like to put it in plain language. So if you've ever felt the pain, just again, anybody, the business owner that's felt pain of having to write a check, I'm going to go back. This is kind of funny, and you've probably experienced this too. I remember when I first got in the industry, came out of college, I struggled in our business just because I wasn't willing to listen and hear some people give me advice. And I thought, man, the year that I made, 6 figures is going to be the year that, I've got it made. And now when you think about the people that I know that are in our similar situation that are writing tax bills for that same amount that you used to think was your freedom number from, 10, 15, 20 years ago. If that's painful to you, if you think about the pain that associates with that, you're going to love this conversation. I'm going to ask you to tune in, pay attention, reach out to me and reach out to us if you say, hey, I'm tired of that pain. And we'll help at least, I can't say we're going to limit it all, but at least how do we mitigate some of that pain in people's lives?
Yeah. How do you turn a headwind that is taxes into a tailwind? That's the fundamental truth that we're going to try to scratch at today.
Yeah, exactly. So, well, before we get down into the technical stuff and get into all that, maybe give me a little bit of your history, your background, because it's pretty interesting. I love where you started, kind of where you came from. You've seen a lot of the world, a lot of the financial world, and that's why I'm interested to say why this and why now.
Sure. I want to keep it brief because I'm not relevant. I'm here like you to work with business owners and help solve their tax problems or have tax dialogues. But my background, Wade, loved the markets my whole life, still do. My favorite place to put money is actually still in investments, but I always felt like something was missing. So what was I doing? My first job out of undergrad 22 years ago now was actually at a mutual fund. So I got like a great buy side investing job. And honestly, one of the best jobs I ever had. Then 2008 came. And you start to understand, whoa, the fragility of some of this, right? What does volatility really mean? It doesn't just mean a markdown in your portfolio. I think everyone understands that. For me, that was also my career. And I sort of had an awakening then and said, okay, I really want to move from the analytical side of the business to a more social role. So I went back to business school at Georgetown to do my MBA. And I wanted to move into wealth management and do more architecture, planning, and investment work. I wanted to integrate more than just which is better, Chevron or Exxon, right? And kind of have a deeper conversation, a more personal conversation. And that was the best decision I ever made. After graduate school, I worked at Wilmington Trust, and I was advising affluent families here in DC where I live. I did that for a few years, and then I had the opportunity to be chief investment officer of a multifamily office. That's when I started to add a skill set of alternative investments, and risk management became really important because affluent families think very differently. And at Wilmington Trust and in the family office, I started to really see the power of life insurance. But it didn't click yet until I became chief investment officer of a community bank, where I oversaw $4 billion of assets, sort of managing those, and then $4 billion of custody. So I was running an $8 billion desk at a community bank. And my biggest clients were like, check this out. This is what I'm doing with life insurance. And I was like, okay, you're telling me to learn this, to pick up the skill set. And so, yeah, I think over time, I'm going to take my two skill sets and merge them. But right now, I took a couple of years out of money management just to focus on dissecting insurance and taxes. And I want to bring that to business owners. So that's a very quick history of me and why I'm here to talk to you and your friends.
So let's touch on that again, because I think the why you're doing what you're doing is so important. But it's the idea of bringing those two worlds together, right? Is that what I hear you saying? Is like
that's going to be where I think the career goes. But why am I doing this? Is, man, wait, you and I spoke a lot at the training we went to in Indianapolis. Like, retirement is tough. Retirement means something differently to everybody. It is a different concept for you than it is for me, than it is for my spouse. And so what I'm trying to do now, my why is to solve the retirement crisis in America. There is one nationally, but I can't solve it nationally. My why, the owner's asset, my company, our why is to solve the retirement crisis for small business owners. And we define that as 50 people or less, 50 employees or less. That is our sweet spot. That is what we wake up every day and say, how do we get the intrepid entrepreneur, the person who went out and took that American leap? How do we make sure they have a glide path on the back end that they are proud of, they're excited for? And we have figured out a way to give them huge tax deductions to get to that glide path.
So I don't know if anybody's picked this up, and I'm sure the listeners are, because they're always a lot quicker than I am, a lot smarter than I am. But the idea of retirement planning, right? That there's a good point to be made there, Ro. Is like that means a lot of things to a lot of different people. I don't think anybody has the same vision for what retirement means. I mean, you talk to my wife and she kind of laughingly says, retirement means just traveling with Wade when he goes on business trips, because I don't plan to retire. But there is a time in my life where like, hey, well, how do I start incorporating some passive income times, right? What's that look like? And I think that's part of the conversation. But how we get there, the question is, are we going to be using the same strategies that everybody else is using, or are we going to think a little bit differently? And from that standpoint of people that, and again, I've just seen this so many times with business owners. They're busy being business owners, doing things that business owners do, which means they understand their inventory, they understand managing their people, leading their company. And it's hard for them sometimes to take the time to understand that, hey, retirement is on the horizon. They think they understand that. They're not sure how that's going to happen, by the way. It's like, I want to retire someday, and I know my business can be part of it, but I haven't given that a whole lot of thought. So we can help with that, right?
Absolutely. God, there's three concepts there. Let's attack them.
Yeah.
And then I have a cool place to start, because you sort of said, hey, we have total latitude to go wherever. So above your left shoulder is probably one of the best books of all time that's ever written, right? Yep. And Nelson Nash does say explicitly in that book, retire is actually an industrial term to put out of service. And I don't think any human aspires to that. So now I'm going to steal from my other all-time favorite book, which is The Psychology of Money by Morgan Housel, where he says, the purpose of money is freedom, and that is to be able to do whatever you want, wherever you want, with whoever you want, right? Whenever you want, wherever you want. And so that's the goal, I think, is retirement, because what those four entail is different for everybody, but everybody's looking for this. Now, this is the third point. So the first is quoting that good book. Second is defining retirement. And third is it is highly personal, but there is a uniform theme to all retirement plans. Okay. And we're going to go to the two schools of thought. I think is a good use for our first 10 minutes, and then we'll get into pension,
Mhm.
pension world. The unifying vein of all retirement planning is surety of income.
Yeah.
Let's start there.
Yeah.
Let's start there. Okay. So let me give you my 2 minutes and interrupt, fire away. I get really passionate about this. And I think what listeners and folks, whether you're a business owner, just and a physician or a traditional W-2, wherever you are in life, in the military, a government servant, that's what we're looking for, some sort of semblance of surety of income. So I think the right place to start is let's take the two bookends of the two schools of thought that are out there and compare and contrast them. Wade Borth is an absolute expert. And you've blown me away since we met a few months ago, but Wade, you're an expert in the guaranteed side, the what will happen side, the insurance and annuity side. So I'm not going to explain that and have you do that because you're better at that. I will start with what is the traditional side because I grew up on that side. I've been converted. So let's start with that. One of the most important days in U.S. financial history is, I believe it was October 1993. Okay, so it's not 1913 when the Federal Reserve was created. Also in that same year, 1913, the U.S. tax code was created. It's not 1929 with the Great Depression. Those are all more important. You're building this up to create some drama and intrigue with the listeners, right? But in 1993, in October of 1993, William Bengen wrote the landmark financial planning piece that gave us the famous 4% rule. They say you're nodding because it's like you sort of could relate to this. This changed the way the investment community, the financial planning community thought about retirement. So I'm going to give you this bookend. That bookend said you can take a 100% bond portfolio to 100% stock portfolio. He tested every 10% iteration there and said, oh, it turns out 60% stocks and 40% bonds let you withdraw 4% a year, and you have a probability, not a guarantee, a probability of never running out of money. And that became the gold standard. That's it.
So I'm going to put a little bit of context to that because I love where you're going with this. But what that said was, and it was interesting, is like you have, I think the 4% rule, and again, there's been debates if it's 3 or 3.5, 4, but it doesn't make any difference. But what success looks like is you have $1 the day you die. You don't run out of money, meaning you have $1 the day you die of your retirement portfolio.
Right. And that's trying to account for sequence of return risk, which is the fact that the market goes up and down. So that school of thought says you should always be accumulating or on the risk curve. And that's how you touch your money. Now, a lot of people get confused. They say, well, if the market's going to return 10 on average, why can't I pull out 7 and never run out of money? Well, it's because the market can go down. So I just want to give the listeners a context. That's one school of thought. Wait, you are the OG. Okay. You're the original gangster on the other school of thought. Tell me a little bit of how you view let's call it the the safety school of thought, safety first school of thought, Wade Pfau's work, or even who wrote Guaranteed Income. He wrote Safety First Retirement Planning. But what's the safety first school of thought, Wade? Teach me.
Well, so the safety first thought is just this idea of like I want to live in the I know world, right? I can't live in the I think world because my definition of success is that you never have to go back and learn a new phrase when you're 85 or 90 years old, and that's welcome to Walmart. Right. I don't want you to have to go back and say, well, hey, welcome to Walmart because you ran out of money. But how do we do that? How do we transfer that risk to people that understand? Because here's the problem. We can have all the money in the world. And I think about the commercials out there. Like, what's your number? Remember, people were carrying around the stupid numbers like, I got
and
here.
Orange dot. Yeah.
Yeah. And so like, what's my number? Well, the number isn't important. I mean, if that's all you had to worry about, that's the only variable in your life. Now, the second variable is how long are you going to live? That's the unknown, right? How do we transfer the unknown to somebody that knows when that is in a big scale, right? And that's transferring over to life insurance companies. And having an asset like properly structured whole life that we use in infinite banking or just in the toughest asset, just for savings, allows us now to say, hey, I can take that money that we've built up in the market, that 401k or whatever it is, and we can turn it into a guaranteed stream of income, guaranteed that's always going to be there for the rest of my life.
Yeah, that's a great summary. That's exactly right. And the answer, what's so funny is I'm still relatively new to insurance, 4 years or so, 2 decades on the other school of thought. The answer is actually both are right and both are wrong. And I think what's so fun about this is you're so open-minded. We should each plan is different for each person, but it helps to know the bookends. Let's put some quick numbers to it. And then I'm going to show how the guaranteed school of thought can be bought via deductions. That's really where I want the episode to go. Is what our core work is at the owner's asset. But okay, so if the 4% rule implies if Wade Borth wants to live off 100 grand a year, he needs 4% of X. So you just do the math, it's 2.5 million, right?
Right.
You need 2.5 million to follow the 4% rule. You still could have a bear market the day you retire. The safety first school of thought, let's say annuities right now are writing at around 7%. That reciprocal is 14. You need about 1.4 million. So if you have between 1.4 and 2.5 and your goal is 100%, is 100K, now it's a sliding scale of how much risk you're comfortable with. What do you want guaranteed? Do you want your housing, your food, and your healthcare bills to always be covered? Then you go with the safety first school of thought for that amount, and you leave the rest in risky assets, the markets, real estate, etc., because that does grow faster than life insurance and annuities, but those go down.
Yeah.
They enter in the industry of either or when it's actually 2 + 2 = 5. And you and I had this dialogue in Indianapolis. So that's why I was excited to come on the show.
Yeah. Well, and I think there's a real key there is if you live extremes in either camp and close your mind off to what other possibilities there might be, I think you're going to leave yourself short. Really, the question we have is how much security, how much certainty do you want to buy? And you say, I want X. I want to at least be able to pay my, for my food, whatever it is you want to pay for. Let's guarantee that part of it. And then have a separate asset that's not correlated to the market. So you might have half of your money still left in the market because you like it, or it gets the return. It is going to outperform because it's an investment. It's not life insurance is not an investment.
Right.
We say that 1,000 times. But at the end of the day, you're saying now when the market does go down, I have a guaranteed asset I can fall back on. So therefore, maybe I can even take out more than the 4% rule because I don't have to take the beatings on the way down and the distribution while the market's down as well. So
that's exactly right.
Yeah. So
that's exactly right.
I think the point is don't entrench yourself in one extreme or the other. Be open to the idea of hey, how much guarantees do I want? So it gives me the ability, the freedom, what we call the permission slip to spend the rest of that. Right.
That's exactly right. So let's start there. Permission slips. What do we do at the owner's asset, and why have our two companies decided to sort of continue to get to know each other? Yeah. There's a way in the tax code to buy that permission slip. You said buy your security. Yep. I love that phrase. And the permission slip. Let's take those two terms. What do we do and how can we help? You can buy permission slip assets via a tax deduction.
Yeah. So
stop.
Okay. So
that's what we do.
Let's talk about that a little bit because here's something I hear again. I have farmers. I have all different industries that I work with, that I know, that I have contact with, and I'm like, what's the number one way people get deductions? Especially like businesses, businesses that they'll buy an asset that typically depreciates.
They're set 179A, right? And farmers love that. The heavy equipment, the plow and all that, the heavy machinery, you should still do that. Don't get me wrong. That's a wonderful deduction that's needed to get working capital investment to your enterprise. Yeah.
What we're talking is a little bit different though. What if we could buy an asset that help us appreciate and give us the deduction? Wouldn't that be fabulous?
That's why I started this company. The heavy vehicle, yeah, there you go. The heavy machinery, heavy vehicle is great, but you're right, you're buying a liability. All deductions fall into one of two camps, Wade. Good deductions and bad deductions. A bad deduction is something that's going to put you on the IRS radar. That's Section 170H, right? A land easement. That is buying a liability. Forget the sections of the code. Buying a liability is a great way to get poorer slowly. What you're also saying, the positive or spin on what you're saying is there are sections of the tax code that let you buy assets and get a deduction to do it. So let's start exploring that. And we're going to be very careful with our language because we're saying assets, not investments. Okay, so an asset, life insurance and annuities are assets. They're not investments. And so interestingly enough, there are ways to do this. So that's what we're going to talk about today. So Any questions before I kind of get rolling here?
No, but let's put it on the spectrum, right? So we first started talking about 401k. That's people that take their money and take it out of their hands, put it into an investment, because those are investments, and they end up losing access to those investments, and they get a deduction for that as well. So that's the start of it. And I think that's what everybody's kind of familiar with, and I just want to bring some commonality to that. Then we move over to the, I call it to the right side of that equation. Further to the right is then we start talking pension plans. There's all kinds of things in between. And really what you're going to talk about, and again, this is why I found our relationship kind of exciting, is because this is something I used to talk with some clients about 10, 15, 20 years ago. So these plans have been around, and to your point, there's other things that put you on the tax radar. These help you take you off the tax radar solid. There's no, well, I always hate to say there's no gray area with the IRS because they can create a gray area if they want. But for the most part, there's no gray area there. It's like these are solid deductions that they're there. They're going to happen. It's like it's proven and they've been around. So this is why I'm excited to talk about how can we create this asset that can help reduce our taxes and give us some certainty and guarantees when it comes to that retirement time. So with that all being said, I'll let you kind of take it away because you're the expert in understanding how these fit into people's. And what I'd like to do is like, who are we talking about? Who can take advantage of this? And then if they can take advantage of it without getting really technical, how do they do that? Because again, I don't need them to know everything you need to know. I just know that if they hear something that they're liking, that they can come to me, reach out to you and say, hey, wait, I need to know more about that because that's exactly what I want to do. So let's help them identify if they're a person that can be taking advantage of this and give it to a high level of at least give them some understanding where they can move with this.
Okay, so let's start with what it is.
Yeah.
And I agree with you that plain English is better. So I'm going to take liberties with certain words, but you can still build a pension. That's what this is. It's technically called cash balance plan, but you can build a pension. That's what this is. Pre-1979 in America, that's when Section 401k was created. It was created in Q3 of 1979. Americans had pensions, okay? This is a pension, and the tax code hasn't changed since then. They say if you want a pension, you can have one. Doesn't mean your company has to sponsor it. You can sponsor your own pension. That's what we're talking about, Wade. You gave a great lead-in of a 401k. Let's start with that. Wade, do you get a tax deduction for your 401k?
I don't do a 401k, but I'll say yes.
Yeah. Same as a pension. You can get a tax deduction for your pension. When you close your 401k, it rolls to an IRA or another qualified account. Yep. Same thing with a pension. You can just roll it to another qualified account. So they're 96% the same. Let's talk about the four differences. We'll do it quickly. And then I still want to answer your question of who can do this, but let's figure out what it is. They need to know what it is that they could do. So yeah, you can buy a pension and you get a huge deduction. Your 401k is stuck at $23,500.
Deduction-wise.
Deduction-wise.
Yeah.
In the pension system, you can deduct 300,000 or more. You can do less. You can do 40 grand, 50 grand, 80 grand, but you can go up to $300,000 a year.
So you can do a person. So
well, yeah. So like a 3-person family, a 3-person farm with active income can deduct almost 300,000 per person. That's $1 million less they can pay in taxes. $900,000 less they can pay in taxes to go buy assets.
Wow.
Yeah, huge. That's it. That changes their life already. That's the first difference. I'm going to go quickly here and then we'll slow way down. But the first difference is the amount that you can do is huge. The second difference, and this is really cool, this is why the books behind you matter a great deal. And I think I've read all of those. They're great books. You can buy life insurance in your pension.
That's always been interesting because I've had a lot of clients ask me, hey, can I buy this with before tax dollars?
This is how you do it. There's only a couple of ways in the entire tax code to buy life insurance with pre-tax dollars. I started this company to find those ways and specifically focus on pensions. I want to re-pensionize the small business owner in America. That's my mission. That's my why. And so, yes, this is how you can do it. Let's put some numbers to this quickly, Wade. If you were going to pay $100,000 of premium for life insurance because you believe in tough money, the Factum way is that training was mind-blowing to me. You should still do that with your after-tax dollars. But if you could pick up a second policy and you wanted to pay $100,000 of premium, you'd have to earn 140 grand, right? 40% tax bracket.
Right.
If you buy with pre-tax dollars, you're getting a deduction. You're only paying 62 grand for that. Would you like a $100,000 guaranteed asset for $62,000 a year?
Absolutely.
Sign me up.
Yeah.
So that's the second reason. The third difference between a K and an A, or a pension and a 401k, and this is a con, we always want to show what's tough about it. The IRS says it's a 3-year commitment. They actually prefer you do a pension for 5 years. Our firm wants you to do it for every year you're working. Why not have your deductions scale with your business, scale with your age? But the IRS is very clear here, Wade. You got to do this for 3 years, but they really want you to do it for 5. We want you to do it for 10, 15, 20. We want you to do it for as long as you're working.
Yeah. And I think the important part here is people, sometimes some people will see this like, oh, this is another expense. And I'm going to say that money's already planned and scheduled to leave your world. The majority of that money. A good chunk of that money is getting ready to leave your world, if you like it or not, because IRS will come and get their money. So
Yeah, you can pay Uncle Sam or you can pay a pension. You can buy a pension.
that's
You
my
can pay
point.
Uncle
Right?
Sam. Yeah.
The money's ready to leave, right? The money's ready to leave.
Yeah.
So the question is, where do you want it to go to?
Yeah, and I've always loved that life insurance is an expense. How can something that's guaranteed to give you more money than you've put in be an expense? That's not the definition of the word. It
Right.
takes time to season, right? But look, guaranteed's a tough word, but we're allowed to use it from a compliance standpoint in three aspects of whole life. We're allowed to use it in the level premium, the death benefit, right? We're allowed to use it in those cases, and the non-forfeiture rate, the guaranteed growth rate. We can't say dividends are guaranteed, right?
Right.
But it can't be an expense if you're guaranteed to get more out than you put in. And let me finish the fourth, and then we'll probably just start going on tangents after that. The fourth difference, and this is really cool, and this is the reason I fell in love with the pension system, I've devoted my career to it, is you can actually pull the insurance out of the pension and use it then for infinite banking. You can literally buy it via a subsidy, get a tax deduction to buy a policy, and then you can pull it out of the pension. There's some nuance there. That's probably another episode, or refer to some of the other work that we've done as an organization. But you can pull it out because you say you put your money in the 401k system, it's trapped. That's true. It's trapped. I like some money trapped because I just can't touch it and do something stupid with it. But if you can pull money out of the retirement system, do it by all means, legally, ethically. But you're telling me I'm going to get $100,000 asset for 62 grand, and I have the option to do something with it down the road all day long. Thank you.
That's the conversation of buying an asset for pennies on the dollar. That's
Exactly
really
right.
what that's the true, the true definition of freedom is, how to refine freedom is through leverage. And that's a sense of leverage. Again, a leverage in a good way, because there's leverage in bad that we can always talk about, and some traps that are always out there. But just think about how you can use the tax code and use a guaranteed asset. Because what we haven't talked about is the death benefit, and that's another leverage conversation that could be very beneficial. I mean, one of the things that's always attracted me to this conversation is like, these are self-completing if that individual dies, and you got a family that you want to leave that guaranteed income to as well. All right, Ro, you and I could go on and on, but for the listener, thank you so much for tuning in. I'll just say, think about this. You're hearing this, you're probably going, that's me, I could benefit. Reach out to us. We'll put Ro's contact information in there in the show notes. Again, we'll have mine there. We'll have those in the show notes. Reach out to us. We can definitely bring value to you if you have the pain of paying taxes, and again, fall into those, those areas of getting a K-1, 1099, or W-2 from a S-Corp. So, Ro, thank you so much, man. I appreciate your time, appreciate your knowledge and understanding this, and really love the fact that we're coming together, partnerships, or not a partnership, a collaboration, because again, that's how people grow, and that's how we can serve more and more people. So thank you so much.
Thanks for having me on. I look forward to spending time together. Thank you.
You bet.
Thanks for joining me today. Remember, small shifts lead to lasting change. Keep thinking differently, keep moving forward, and we'll see you next time.